I found this report from Donald Trump very interesting, drawing attention to Jim Rickards' assessment that gold could hit $10,000 by the end of 2026 and possibly 20,000. Now, Trump reposted this. Was that a shot across Bessent's bow? I mean, Bessent's push for lower long yields has intensified the weak dollar debasement trade, so that's clearly not gone unnoticed. And that's obviously sharply lifting gold. And while Bessent comes from a trading background, unleashing gold, as I say earlier, was either a major error or he is setting up the gold revaluation trigger. Again, no coincidences here.
Global monetary structures are undergoing a profound transformation as institutional confidence in debt-backed sovereign assets continues to deteriorate rapidly. Mounting national debt, credit downgrades, and aggressive reserve weaponization have driven global central banks to systematically diversify out of paper instruments into physical hard assets. Andrew Maguire, an esteemed wholesale bullion expert and veteran precious metals analyst, underscores that physical clearing mechanisms are taking complete dominance over synthetic market pricing. He focuses on projections, noting that gold could surge toward $10,000 by the end of 2026, with realistic potential extensions heading to $20,000 as dollar debasement trends accelerate. Furthermore, immediate technical trajectories indicate a rapid move towards $6,000 over the coming 6 to 8 weeks, followed by an end of fourth quarter physical clearing price target near $8,000. This structural shift indicates silver is also primed for an unprecedented short squeeze above $100 and into the $140 territory. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Shanghai is offering one-to-one physically backed allocated deliverable metal. So as price discovery shifts east and physical settlement gains traction, the Fed's exposure is not just gold ownership, it's gold trust. If, as suspected, the ETF custodial or official sector gold has been rehypothecated into multiple claims, and bear in mind that ETFs are not sanctioned to lease out metal, but on the other hand, short selling and swaps get around this so-called protection. So basically shrinking. So into all of this, because there's no other way, they have to hide it somewhere in unallocated form. That's why we think the ETFs are being rehypothecated. Essentially, into all of this, we've got shrinking COMEX liquidity and rising physical demand. It's going to force those claims back towards settlement. Now, at that point, there is no escape. Fort Knox becomes a verification and a balance sheet credibility issue. Short of confiscation, we kind of looked at this before in the past. Short, you can't confiscate. You can't really default. The cleanest policy release valve is to revalue US Treasury gold to market, turning a paper gold liability problem into a sovereign balance sheet repair mechanism. Now, Bessent's concurrent push for lower long-end yields and that intensified last week. So it's also intensified the weak dollar debasement trade, sharply lifting gold. Now, given Bessent comes from a trading background, unleashing gold was either a major error or he's setting up the gold revaluation trigger. So I'll leave it for you to think about, but there's no coincidences here. Gold is returning as gold reserve collateral because confidence is in debt-backed sovereign paper, especially US treasuries, is eroding under the weight of record debt, fiscal deterioration, ratings downgrades, reserve weaponizations. And we saw more of those just this week, just yesterday. Central banks are rebuilding gold reserves because gold is liquid, universally accepted, and no one else's liability. So marking a clear shift in official reserve preference away from paper debt and towards physical gold, global central bank holdings now exceed foreign official US Treasury holdings. They have done now for some months. Currently, it's about 5 trillion versus 4 trillion. That's quite a crossover. And that crossover came in the first half of this year alone, fueled by sustained official buying and gold's price surge. Gold also overtook treasuries as a share of total reserves for the first time since the mid 1990s, reaching about 27% versus 22% by the end of 2025. So gold's not, but this is where a lot of people get it wrong and arguments evolve. Gold is not replacing the dollar. It's reasserting itself alongside it. Central banks and sovereign institutions are diversifying reserves, increasing physical gold allocations, and building settlement systems beyond the dollar framework. It's that simple. The dollar remains dominant, but its monopoly over monetary trust is being steadily diluted. That's what we're seeing now. Gold's advantage is neutrality. No issuer risk, no counterparty exposure, no sanction risks, no dependence on another sovereign's balance sheet. So in short, gold's monetary value comes from what it does not require. No issuer, no promise, no political backing, and no faith in another country's balance sheet. That's the focus. However, what we are currently evidencing is this gold remonetization race is hitting a physical wall. Now, at current prices, there is not enough readily deliverable gold to absorb this serious rotation out of debt-backed US Treasuries into hard collateral. And this is driving the shift from underpriced cash-settled unallocated gold to physically determined, fully paid up allocated ownership. This issue is no longer just available supply, but whether trusted physical metal can be mobilized quickly, securely, and at scale. By design, the recently expanded Hong Kong SGE physical settled gold corridor attacks that bottleneck directly. So the SGE's expanding trusted gold collateral rails ultimately open global access to, as I say, roughly 60,000 tons of physical bullion, providing central bank sovereigns and institutions the liquidity to swap dollar debt for real metal. That's happening. The shift towards physical allocation at real supply-demand clearing prices is structurally repricing gold higher into tightening deliverable supply. This is an ongoing process, but with wholesale gold still anchored to a vast base of unallocated paper claims, the market must revalue materially to absorb this reserve migration. And in this framework, a fourth quarter bullion offer price near $8,000, it's not an outlier. It is the clearing price required by a changing market structure. And as we just looked at, post-Basel III, physically settled venues such as Hong Kong and Shanghai Gold Exchange, they're accelerating the transition from paper price discovery to deliverable metal clearing. But as synthetic dilution loses pricing power, paper-derived downside forecasts become increasingly redundant, and we see them popping up all over the place. People who have an incentive to try and talk gold down, that is. The institutional reality is a market being forced towards a substantially higher physical clearing price. So bottom line, gold's breakout is being driven by a shift from rate-sensitive liquidation back into structural accumulation, led by Chinese demand, technical buying, central bank support, and renewed monetary debasement hedging. By the way, I found this report from Donald Trump very interesting, drawing attention to Jim Rickards' assessment that gold could hit $10,000 by the end of 2026 and possibly 20,000. Now, Trump reposted this. Was that a shot across Besson's bow? I mean, Besson's push for lower long yields has intensified the weak dollar debasement trade, so that's clearly not gone unnoticed. And that's obviously sharply lifting gold. And while Besson comes from a trading background, unleashing gold, as I say earlier, was either a major error or he is setting up the gold revaluation trigger. Again, no coincidences here.
Price discovery is aggressively migrating away from Western derivative exchanges and establishing a new base across Eastern physical settlement hubs. The structural expansion connecting the Shanghai Gold Exchange and Hong Kong now provides direct rails to roughly 60,000 metric tons of physical bullion, offering central banks and sovereign institutions the necessary liquidity to exchange dollar debt for unallocated free metal. Official gold reserves held by global central banks have now overtaken foreign holdings of U.S. treasuries, reflecting a historic shift in global reserve preferences. As COMEX liquidity shrinks and requests for physical delivery intensify, traditional paper mechanisms such as leasing, swaps, and short selling are losing their ability to suppress spot valuations. This physical migration exposes the vulnerability of unallocated custody schemes, forcing global markets to accept pure supply and demand clearing prices. Now, let's get back to the interview.
The latest World Gold Council data showing the PBOC gold accumulations in July had already pointed to a significant structural tailwind for gold. And this reinforces the increasing strength of the physical market, and it highlights the growing policy constraints facing the Federal Reserve. They don't have it all their own way anymore. We're going to delve into the Fed in a minute, but to provide context, let's quickly look at what China lifting the veil actually means and why this leads right back to our $8,000 end of fourth quarter target. Now, very, very short term, gold has detached from the curve steepening support. Now, if you remember, this is where Besant came in, and then we saw basically this was all pretty much up to around about here, the 200-day moving average here, and just above it, really started to detach slightly from this curve steepening support, leaving momentum and positioning in control. Now, a Fed pushback from Walsh at Jackson Hole on Friday could open up dip buying opportunities into which strong underlying Asian physical demand will underpin the dip. Now, personally, I don't see anything new coming out of Jackson Hole, but experience tells me never looked a gift horse in the mouth, especially when we can take paper gold and paper silver and convert it into physical against the house. Now, while of course maintaining our physical stack long and strong, we would view any dip into the spot adjusted 45-80 200-day moving average. So that is actually right here. And that's going to rise a bit by Friday, probably 82 or 83, 45, 83 probably. We would see that as sufficient to reject all of the fresh froth and provide good value ahead of the next Asian-driven, physically underpinned push higher into and above the January all-time highs. And a move above there, and this is the same charts that we were looking at back in January. So obviously a lot happened along the way, but really nothing's changed. We're looking at 6,000 coming up, probably in the next 6 weeks. And by the end of the quarter, we're still looking at the end of the fourth quarter, looking at probably 8,000. And all the reasons for that have been given earlier. Silver also continues to evidence very strong Shanghai premiums, illustrating tight demand. The current bull pivot setup, which we looked at a little while ago on the futures charts, has so far evidenced commercials taking the long side of underlying physical support. So we're really just looking at what's going on in the physical markets and marrying it up with some of the short-term technicals. You would see any dip below this level as the commercials having to buy it. As far as silver is concerned, the same Hong Kong SGE physical derived real supply demand pricing architecture is increasingly influencing the market. It is also forcing arbitrage between the consistently elevated around 13% Shanghai premium over spot and the diluted London silver spot fixes. Now, liquidity providers report that this increasingly liquid bullish pricing architecture is now pulling silver business away from London, and this remains extremely bullish for silver. Now, once silver breaks away from its capped 200-day moving average, it opens up a blue sky short squeeze above $100 into the 140 range also, just when the least expected. So in closing, what's striking is how many new investors are waking up to gold as real wealth protection. Getting so many people coming, that people who've never looked at gold. I'm talking about large funds, hedge funds. We're talking about family offices. We're talking about people we meet in the pub. It's not escaping them that gold is safe haven wealth protection. But as stackers, we are still well ahead of this curve. Ignore the volatility. Hold your physical. Be part of the solution and keep stacking. The reset is coming. Make sure you're holding real metal when it arrives.
The tightening across the precious metals complex extends deeply into the physical silver market. Persistent Shanghai premiums hovering around 13% over Western spot prices continue to pull immense liquidity and physical inventory away from traditional London fixing venues. Commercial traders and institutions are increasingly taking the long side of physical support, as arbitrage pressures force synthetic pricing models to break down. The neutrality of physical bullion carrying zero counterparty exposure, zero liability, and absolute immunity from political sanctions has made it the essential reserve collateral of modern finance. Large hedge funds, family offices, and individual stackers are building their physical holdings to insulate balance sheets ahead of an inevitable global monetary realignment. Physical allocation remains the only reliable shelter against paper currency dilution. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.